Okay. Yeah. So the purpose of this Q&A really is it's a chance for me to remind people exactly what this is we're doing, how it's working, what the mechanisms are. I've had a lot of questions over the past 6 weeks or so, so I'm going to have some questions of my own kind of prepared, or of other people's prepared, and then just open up the Q&A section basically. So it, I hope, I don't hope, I think it's probably going to be about 30 to 40 minutes, so then we can get along with our days. And yeah, I appreciate everyone who's here. Um, even if you don't contribute anything, you're just here to watch. You know, it's nice to know I'm not just speaking to to the ether. All right, so a real quick summary for those of you who are either familiar and need a refresher, or who are not familiar. Kind of what is the SPV? Basically, we on Folio we have access to a lot of profitable agencies that are for sale for attractive prices. And in order for us to acquire those businesses, we are looking for investors to come in the deals with us, mostly to put up the upfront cash part of a deal. And so, to give you an example, there might be a business that's for sale for $1 million, and the founder is willing to take 300K cash up front, 300K on Folio preferred shares, 300K as a seller note paid out over time. So that's 900K total, and then maybe they retain 10% equity themselves to make up the 100%. And so from our case, we say, okay, well, we can give you preferred shares. Great. We'll give you a seller note, which will pay out over time. Great. So that's 600K. Where do we find the other 300K? We don't have a finite amount of cash, or we don't have an infinite amount of cash ourselves. And so what we're doing is we're borrowing from the search fund model, which would be somebody that they're going to go out and buy a business, and they're going to take some debt from a bank, and then they bring in equity investors to help with the upfront cash payment. So essentially, investors such as yourselves and people who have already participated in the SPV will help with the upfront cash portion, and then we're able to acquire the business. And so this kind of brings me to the first question, where a lot of people have asked, how does OnFolio, how does it all interplay with OnFolio? Like, is this a separate thing that I'm doing? Is it like a fund? You know, how does everything work? Basically, it's a complete OnFolio venture, and we're just having investors co-invest into our deals, basically. Now, why it's good for investors is because the return profile is good. So if we go back to that $1 million example, that business, we're going to be buying it for something like a 3 to 3.5 times multiple. So if we just go with 3, keep it easier. So that business is probably producing about 330K of profit a year. So that's why it's being bought for $1 million. And then investors would put in, let's say OnFolio put no cash into that deal, and it was all the SPV. So in that case, the SPV would own about 30% of the business, and OnFolio would own about 60, and then the founder would retain 10. So from that 300K that the SPV put in, they would expect to receive a little bit over 100K back in profit per year, which is around a 30% ROI. You know, give or take, a little bit higher, a little bit lower, depending on the fluctuations of the business. But that's how it works. So from our end, it's great because we think, okay, we can buy all these businesses. We found some investors to help us put the upfront cash in. And for investors, it's great because they say, okay, we can spread our money around multiple businesses. and we're going to be diversified. We don't have to run these businesses ourselves. Onfolio is going to be doing them. You also get a few extra benefits because we're a public company. You know that our board has approved every acquisition. So you get that kind of public company governance alongside it, and all of the financials get audited and everything. But ultimately, the attraction, the reason you invest your money is to get a good return. So that's kind of the real benefit for investors. Okay, I'm going to put up a relevant slide here. So let me share screen. Okay, this one. So this is a slide that you may have seen before, which is an example cash flow on a $100,000 investment. And I thought I made it really nice and clear, but this slide probably produced the most questions among people in the audience. So I wanted to spend a bit of time on it. And first of all, 100K is not the minimum. I put 100K in because I like round numbers. And if I put 10K, everyone would invest 10K. But I want some people to invest 50K, 100K, 200K. So, it's just like this is what a 100K investment should yield, but it's not like you have to invest 100. So year one, we're expecting about 15K cash flow from a 100K investment. So the return will be a little bit lower. That's because as the money comes in, we don't buy every single business on day one. So, we buy one or two businesses in the first couple of weeks, and then we buy the next one, and then we buy the next one. So by the time the first year ends, we'll have all of the businesses and we'll be on a 25% trajectory, but we won't have actually received all the money in that time. So therefore it's a little bit lower cash flow. And then year two, it increases. And the reason it increases every year, it's increasing by around 10%. That's because we're assuming that overall the portfolio is going to grow by about 10%. And we're thinking we'll buy around 5 businesses. So based on our own experiences and kind of just speaking to other people and so on, what we'll see is of those 5 businesses, one of them maybe will actually grow 100%. One of them might decline a little bit. One of them will stay flat. Maybe 2 of them will stay flat, and another one will grow, say, 20%. And so 10% growth across the portfolio, definitely achievable. Maybe it's on the conservative side. Maybe they actually grow a little bit more. So there may be some opportunities for more capital gains as well as the cash flows. So what this cumulative row refers to is just like, okay, year one, maybe you got 15K, year two, you got 25K. So now you would have received 40. And so it just adds up all of these. And so in this case, if you put in 100K, we're expecting from the dividends, you to have made back your 100K by year 4. But then the value of your investment, we're expecting it to be about 130K. So if you decided to exit at that point, and I'm going to talk a little bit about the mechanics of that as well. But if you decided to exit at that point, then you'd essentially have turned 100K into about 220-ish K, 230K in 4 years, which is pretty good. And so the NAV just refers to the asset value. So it's basically, if you put in 100K, how much is that investment worth? And so because we're assuming everything grows by about 10% every year, that number increases. Now, because this isn't structured like a fund, and we're structuring it more like permanent capital, so we're hoping to hold these businesses forever, which is another reason we like agencies, because agencies can they can evolve, they can pivot, they can change their offerings as the internet changes. So maybe the services that they offered 3 years ago are gone in 2 years, but the actual agency itself will live on. So we're kind of like, hey, we want to hold these forever. If you want to stay a co-investor with us forever, great. But the reality is people are going to want their money back at some point. They're going to say, hey, I've got some good returns here. I'd like to lock them in. I want to buy a house. I want to do this. Like maybe the growth in year 6, it flatlines and there's no more growth. So they say, I might as well, cash out. Stuff happens, life gets in the way, all these reasons. People may say, you know what, I want to cash out. How can I do that? So we've got a mechanism, and it's in the term sheet, the subscription agreement, the operating agreement, where once a year an investor can say, so at the end of the year, we'll say, hey, here's what your NAV is. So you put in 50K, it's now worth 55K. What do you want to do? Do you want to stay in for the next year, or do you want to cash out? And an investor can say yay or nay, basically. So like, I'll cash out. I'll cash out half of it. Actually, that's one option. I'll cash out. Don't let's not get too complicated, but in theory, you could cash out like 27%. Or you say, I'm good for another year, and then the cashing out mechanism will probably be on folio, just buying out your shares. But it might be that another investor's knocking on the door saying, hey, can I come in? And we'll say, okay, yeah, you can buy someone else's shares. So I actually borrowed this idea from Warren Buffett before he started Berkshire Hathaway. He managed lots of different funds for people, and he said, yeah, once a year you can ask for your money back, or not ask for it back, but you can cash out. Or you say you're good for another year, because that way for us, we don't have to be thinking all year, about constantly needing to have liquidity for people. It's just like, at the end of every year, let's see who wants in or out, or who wants to continue or out, and then we're good for like 9-10 months before we have to think about it again. Okay, I think that's that slide covered. Another question, actually, this came up 2 or 3 times, and so I will spend a little bit of time on it. But some people have asked me, what is an agency? What do we define as an agency? Because an agency could be quite a broad thing. And so basically for us, it's usually B2B, sometimes B2C marketing company. So could be a company that helps people with email marketing, with their Google ads or their Facebook ads, SEO, search engine optimization. Could be RevOps, which is kind of like the marketing architecture of a business. Basically, yeah, anything in that B2B marketing space. We're not going to strictly stay in marketing agencies, but I would say 99% of our current deal flow is marketing agencies. So I just want to give us the optionality to buy something else if it's an agency, but maybe not, maybe not marketing. So an example would be like the previous acquisition we made, RevenueZen. This is a company that helps people with their SEO, but they also do a few other services. So they have some LinkedIn marketing, some content marketing. So essentially, there's a company that says, hey, we do this thing. We need help with marketing. So they'll work with the RevenueZen team to do it. So yeah, hopefully that's clarified that. In terms of size, the average agency that we're looking at is anywhere from probably 1 to 5 million revenue. Some of them are actually a bit bigger. Some of them might be a little bit smaller. We'll go smaller if it makes sense strategically. Like let's say, for example, let's say RevenueZen, they do LinkedIn marketing services. Let's say we saw a small LinkedIn marketing agency that maybe it only does 500K revenue and it has 200K profit. Normally we'd say no thanks to a business that size, but if we can tuck it into an existing one, then it makes sense, especially if there's going to be a lot of value adds on both sides. The other thing I wanted to give an update on is kind of progress. So we launched this SPV about 2 months ago, maybe just a little under 2 months ago. So far we've raised around about 1 million of our target. Our target's 2.5, but I think what's crucial or very important to know is we don't have to get the 2.5 in order for us to start making acquisitions, or in order for the fund or the SPV to actually be successful. So right now we've got 2 businesses that we are hoping to close on very soon, and I will give more I'll go into more details on that in a second. But of those two businesses, we also have enough money already committed to acquire a third. And so those investors are already going to start generating a return. And if we just stopped here and we said, okay, we'll just buy these three businesses, there wasn't enough demand, we only raised $1 million, not a big deal. That actually would still be enough. It would be enough for Onfolio to reach profitability from the acquisitions that we've got in the pipeline. And it would be enough for the SPV to meet its goals. Investors would get good returns. They would be diversified. There would be enough profits to justify the hassle and the admin and everything. So we're actually in a pretty good shape already. The reason we want to raise more is because, well, more profits. But basically, I think having 5 businesses is or 6 is a little bit more diversified, and so the target is 2, but if we only get 1 or we only get 1.5, we'll just stop there and it's fine. We also don't want to drag this out forever. There are some people who are kind of waiting to be the last investor in so that they can just deploy money and it starts generating returns straight away. But that's actually the case already, that you can do that because we've got 2 businesses that we're going to buy already. And so another question somebody asked me was, if, let's say we buy 2 businesses today or next week or something like that, but then somebody doesn't join the SPV until 3 weeks later, will they be invested in the existing businesses? Or the other way around, if somebody invests now, will they only be invested in these first businesses and not the future ones? And so the answer is that's not how it works. Basically, whether you're the first dollar in or the last dollar in, your dollars are going to be spread among every business in the SPV. So obviously, from our point of view, it's way better if everybody invests sooner, because then we can just focus on structuring deals, doing due diligence, operating the businesses, giving people a return. We don't have to focus on raising. Okay. So I think at this point, I've covered everything that we need to cover from a overview and a summary point of view and a kind of progress point of view. So I'm going to go into the first question that somebody sent me over the weekend, which was basically, when do we anticipate closing on these first couple of businesses? And we're targeting the end of the month. So it's May 15th, May 16th for some of you. But the first 2 businesses that we're going to buy, we have finalized the agreements, we finished the due diligence. Our lawyer has drafted up the purchase agreements. We've sent the purchase agreements to the business owners. The first business owner has sent back a redlined version with some light tweaks. So that one actually will probably be ready before the end of the month. And the second team, they're still reviewing it. I only sent it to them on Friday, so they haven't had long. But we spoke on Monday, and they said they hadn't. There was nothing in there that they didn't expect. So I anticipate there shouldn't be any issues from a kind of legal and paperwork timeline, and we've already raised enough money to be able to buy the businesses. So unless things just take longer than I expect, which sometimes they can, we should be closing those by the end of the month. And beyond that, we've got 2, maybe 3 other agencies that are a little bit further back in the queue. So we're in negotiations. We've done some initial due diligence. We like the businesses. We're speaking with the founders. Sometimes it's a little bit trickier because with this structure, they might say, "Hey, can I get 100% cash up front?" And we're like, "Well, no," because that's not how it works. And so sometimes that takes a little bit longer, so it's harder to predict. But because we're speaking to 3 or 4, and there's probably 2 where we're ready to make a formal offer, and we know that we've got more or less enough money for one of them, and from people who have indicated that they want to invest in the SPV, but they haven't put any money in yet, or they haven't signed the paperwork or anything, we can kind of guess that there's probably another 500k. So maybe we're on about 1.5. So that means we probably can already afford two of the other businesses we're looking at, bring it to a total of 4. So that would mean, let's say we close 2 May 31st, and then 1 or 2 more in June, and then 1 or 2 more in July, and probably job done. So all the money will be invested by then, and then the latter part of Q3 and all of Q4 is just about optimizing the businesses and paying out funds and everything. Yeah, so now's a good time. Actually, let me change the slide. Questions? Okay, now's a good time to ask questions. I think questions are anonymous, so if you don't, no one else will see it. Don't worry about that. But you can also email me, dom@folio.com, or you can, yeah, if you want to have a one-on-one call with me or something like that, you just reach out and we'll get that scheduled. Okay, so 2 questions come in. Let me go back to that. So the first one, someone said, if everything was sold at, say, year 6, how much equity dump would we get with 100k? Well, assuming that this slide here is accurate and it plays out, we get 10%, 10%, 10%, 10%, 10%. You would probably get 160k in year 6. So you would have received you'd have received about 160k worth of dividends, and then you'd have 160k payout as well. So yeah, and then year 7, year 8, it would go further. And then what's the policy regarding reinvesting profits versus offering dividends? Yeah, I need to double check, but I've had a lot of people asking me this, and I'm okay with it. I just need to make sure that like it's permissible within the operating agreement. But yeah, a lot of people are saying, can we just reinvest the profits versus offering dividends? And I think as long as there's more businesses for us to acquire, or maybe there's another investor who wants out and you can reinvest your profits to buy out another investor or something, I think it makes a lot of sense. Yeah, I just need to make sure that it's doable. So someone else said, already invested in the SPV, but want to invest more. Do I have to start every time new paperwork, or can I just add to the previous agreement? The way Dealmaker works, well, there's a couple of different answers. But the way Dealmaker works is you can't go back and amend the agreement you've already done, where you've filled out your investment amount and you've signed the agreement and everything, because that's signed and that's accepted. But I can manually just add another one for you because I've already got all your details. So like I already know your name, your address, and all of those things, like your accredited investor status and everything. And I just manually write down your investment amount and then you wire it. Or yeah, you go in again and do it, but you don't have to prove that you're accredited a second time and everything like that. Yeah, so it's kind of not adding to the previous agreement, but it's not you having to go through and start everything again from scratch. And then, sorry, yeah. So apparently I didn't explain the year 6 thing. So yeah, the equity at year 6, this is a cumulative cash flow. So sorry, if year 6 everything was sold, you would probably have, let's say it's at the end of year 6. So in year 6, you would have received 36k worth of dividends. And then you would receive 160k cash out as well. Now, in reality, if we're selling in year 6, we might say we won't pay any dividends. We'll just sell the businesses, and then everyone gets all their cash. So maybe you would get like 196k at the end of year 6 because you get the 36k worth of dividends plus that. I'll just wait a sec for any more questions to come in. I also had a couple come in via email. But another question I had, and I've kind of answered it a bit already, is like why agencies and how many agencies are there to buy? And so there's kind of 2 reasons really. There's a lot of agencies for sale. A lot of them, frankly, a lot of them are not very good, but there's a lot that are good and attractive to us. And we have bought 5, possibly 6 agencies over the years. And about a year ago, we were looking internally at like, how's this business performed? How's that business performed? And most of our best performers were agencies. And so we thought, okay, maybe we should lean into this a bit more. But the other thing is the effort of raising money and doing an SPV, we wanted it to be built around one core thesis. We didn't want to be like, hey, we might buy some agencies, we might buy some e-commerce, just give us money and we'll figure it out later. We kind of wanted like, here's the thing we're going to do. And we didn't want to have to keep raising every time we had a deal. Like, okay, this business is for sale, who's in? That business is for sale, who's in? So it's really about, we wanted to build a strategy that we knew we could fulfill, we could deliver on. And there were enough targets for us to acquire, and investors can understand as well. Like, not to be saying investors don't understand, but we've definitely confused people in the past with all the different things we do. So that's kind of like, there's a lot of opportunity, there's a lot of strong returns, and it's very simple to understand. So someone said, what happens when a biz goes into distress and needs external funding? I don't, this is one of those things where I'm like, that's not going to happen, but that's not a very good answer. So there's a few options, but ultimately on folio would be, say, like a 70%, 60% owner of that business. And the investors would be, 20, 30%. So it's really on folio to solve that problem. Maybe we say, we're going to lend that business some money, or maybe we say we want to put some more money into that business. Do investors want to match? Or, can we increase our ownership a little bit? What I don't want to do is start like taking profits from other businesses to prop up that business, because if one business goes into distress, and actually with agencies, the good thing is it's hard for an agency to go into distress. It can definitely have periods where it goes through a period where like it doesn't make that many profits, but an agency can kind of scale up and scale down its workforce as it needs to. So what would probably happen is it would just not perform very well. Like, maybe instead of getting 25%, it would get 5% returns. And so then we would say, well, do we want to put more money into this? Will that help it grow? Or do we just accept that this one's not as profitable as it used to be? And, just what cash flow it produces is what cash flow it produces. And then luckily the other businesses are performing well. So that's kind of another reason we like agencies. Like an e-commerce business, you have to constantly pour money back into it, because you just constantly need to be spending money in ads, buying more inventory. Maybe if you want to produce new line extensions and so on, you have to first create the product and then manufacture it and then hope it's going to sell. Whereas agencies don't really have that issue. The benefits of agencies is they're very people focused, and so they rarely go into distress. But yeah, basically we would have to make the best decision at the time if that did happen. Okay, how much has been raised? How much is left? When is the deadline to invest? So far about 1 million has been raised. about 1.5 million is left. It's tricky to know for sure because there's probably anywhere from 500,000 to 1 million out there in people who are like, I'm in, but I'm not, I'm in, let me figure out how much I'm in for and when I'm in. And realistically, some of those people will back out because that's just what happens. Some of those people will end up coming in for more than they said. And some people will come in for less. So it's really hard for me to know exactly how much is left, but I would say there's about 1 million to 1.5 million left. Oh, and when is the deadline to invest? I'll say probably by the end of June. We won't want to deal with having more people invest. So if you haven't invested by then even if we've still got, say, in theory, 500k left available, we would just shut it down. So call it 6 weeks. But I don't even know if there's still going to be any left in 6 weeks. Okay, so next question. If Onfolio and the SPV distributes all the profits as dividends and capital gains are also passed on to investors, how does Onfolio make money? Well, there's two things. One is we make money because we're also buying these businesses. We'll be the majority shareholder. So we're making money. Let me go back to pull up the right slide. Got the right slide? No. Okay, so here's an example structure. If a business is listed for 1 million, the SPV, which is you guys, would put in 300k and get 30% ownership, and we put in 700k, we would get 70% ownership. The difference is the 700k we put in wouldn't necessarily be cash. Some of it would be a seller note. Some of it would be we give the founder some of our preferred shares. And so we make money the same way investors make money from the profits of the business. But also, there is a small management fee that Onfolio charges. It's based on, whereas normal management fee, it's like there's a 2% management fee plus 20% of profits. We just have a management fee based on distributions. So I'm trying to find it. Here it is. Yeah, so Onfolio, the manager, which is Onfolio Management LLC, takes 10% of the distributions that go to the SPV. And so if the SPV doesn't get anything, then there's no management fee. There's no like upfront management fee or anything. And that is, yeah, so the returns that I'm projecting here, these are after fees. They're not like the fees don't reduce these. So someone said, would any of the businesses have the opportunity to add influencer marketing, i.e. a podcast, YouTube, or is the value add standard SEO, link building, sales marketing? Well, I think both. Yeah, I assume you're meaning add influencer marketing. Well, I don't know. So I'll answer both. If you're asking, could we add influencer marketing as a service that the agencies offer? Yeah, unfortunately, the questions that there was about 3 questions that I was about to get to, and I lost them all when I got kicked out there. So if anyone had a question that I didn't get to, please just type it again. But for the meantime, I was in the middle of answering one question about influencer marketing. So yeah, the question was, can you add influencer marketing? And so I wasn't sure if that person meant, can we use influencer marketing to grow the agency, like the way you see some people on Twitter and LinkedIn advertising their agencies? And I would say, yes, we can definitely do that. Or if the question was adding influencer marketing as a service, harder to do. But yeah, in fact, actually, one of the businesses we're looking at is an influencer marketing agency, one of the biggest ones, or one of the first ones. So that would be interesting, because then we could then help out the other clients or the other agencies with the same service. So yes to both, basically. Another question's come in. Thank you. When will you be purchasing the first business? I talked a little bit about that earlier on, but basically there's two that we're probably going to purchase by the end of the month. One of them might be ready probably by the end of this week, but realistically, if it's like the 25th of May or something, it's cleaner to just do it at the end of the month. So probably May 31st, we'll be buying two of them. So yeah, people can start cash flowing from the end of the month. Well, from the end of the quarter. Okay. So there's only like 3 attendees now. There was about 20 before. So I think most of the questions were covered. I don't think anyone else is going to come back. I'm not going to bother sending an email saying, sorry, we're back. So I'll just wait a minute in case any of you guys are typing a question. But otherwise, yeah, I appreciate everyone attending. Very engaged questions and audience. So, definitely makes it worthwhile for me. Someone else just joined. So if you just joined and you had another question for me, please type it quickly. Otherwise, I was just telling everyone that I think we can wrap it up here, and apologies for the technical glitch. Yeah, you're welcome. Thanks. All right. Well, yeah, I will send a replay out to everybody. And if anyone thinks of any questions after watching this, dom@onfolio.com is the place to find me. If you want to schedule a call, you can. One question just came in. How long before the next SPV? Good question. I think so. It kind of depends how this one plays out, but assuming this one, let's say this one closes in June, we raise the full amount, we'll then switch our focus to actually operating the businesses, but there's still plenty more acquisitions out there. So we could turn around and say, should we raise another couple of million? At that point, the option is going to be, do we want to do more agencies? If we want to do more agencies, then the choice is either should we do another SPV, or should we just expand the existing SPV and let more investors come in and use that capital to buy more businesses? But there's also other kind of investment strategies we have, different philosophies, different theses, such as online courses, e-commerce businesses, making more minority investments. And so we will probably do another SPV towards the end of the year, just not entirely sure what the format's going to be, or what the strategy is going to be. Okay, well, I don't think any more questions are coming in, so I've already sort of said my goodbyes. So yeah, thanks everyone for attending, and I'll send the replay around.